Ladies and gentlemen, also from my side, a warm welcome to everybody of you. So my name is Sebastiano Lange. I'm currently studying here at WHU, and I will accompany you throughout the program today in this room. It is an honor for me to announce our next speaker, our first speaker after the lunch. It's Burkhard Varnholt. He is currently Global Investment Strategist at Bank Zerzin. He might want you to know that he's going to change to another bank in Switzerland soon. After graduating from the University of St. Gallen with a PhD in economics and a bachelor in law, he joined Morgan Stanley in London, where he held various management positions. Prior to joining Bank Zerzin, Varnholt spent 10 years with Credit Suisse, where he was a member of the Global Executive Council. Besides his professional career, Mr. Varnholt lectures regularly at the Executive MBA program at the University of St. Gallen and has published more than 100 articles and 5 books. Moreover, he established the charity Kids of Africa, the Swiss African Orphanage, which provides a home for orphaned and abandoned children in Uganda. I'm sorry for that. So, Mr. Varnholt, it's an honor for us that you're with us today, and now the stage is yours.
Well, thank you so much for inviting me today. It's a great pleasure to be here. It's something that I took particular pleasure and pride in joining you, being the most respected business school in Europe, but also because I've generally taken a great interest in academia, as you kindly heard from the introduction. Look, what I'll try to do today is share with you some of my 2 cents worth on what I see as a new world order emerging. And that will directly relate to the topic of this conference, which is the financial services industry. Will it break down or revive? I think it will do neither. It will just continue to grow. And there's not the slightest doubt in my mind to it continuing to grow. That doesn't mean that it necessarily has to grow in good old Germany. The economic center of the world has already fast moved eastwards from here. But it will if you take a global perspective. And that's the perspective which I'm sure matters most to you. But before I get started, let me begin with 1 or 2 short caveats on why talks like mine often fail so utterly and sometimes embarrassingly. All of you, I believe, have read bold predictions about the future, be it financial market or economic predictions. And once every while, they fail utterly. You remember that analysts, economists, journalists, and professors were generally blamed for not having spotted the banking crisis in 2007 well ahead, and there are many other examples. Now, why do these predictions fail so often? If at least we understand some of the flaws in our thinking, I believe it will help us to come to safer, sounder conclusions when it comes to our own professional or personal decisions, whatever you may want to take. Let me start with just one observation. Every one of you, every one of us, as we grew up, we learned certain things from early childhood day onwards. We learned them in school, we learned them throughout our professional careers. And as we apply our experience, our collective experience in taking everyday decisions, at university, in our offices, or at home, we implicitly assume that those laws which we somehow learned during our past 30-odd years or so will still apply today, which is just an illustration of how the human brain, of how human logic works. And it works so because it was a good law that allowed human evolution. It works like an arrow. From past experience into today, it tries to anticipate and manage the future. And the trouble with that is that in an unprecedented way, we are seeing an introduction of far more nonlinear developments into social, economic, political, and all other sorts of developments in the 21st century than humankind has ever seen. Let me give you just one or two examples. Think 100 years ago, the time of your grandparents. The world counted roughly 1 billion, probably even less, inhabitants. It was only 2 generations ago that the world counted roughly 2 billion people. Today it counts 7 billion people. 1 generation down the road there'll be 9, arguably 10 billion people before global demographic growth is likely to peak, as the United Nations would like us to believe. That's just one illustration of a highly non-linear exponential growth curve. Take human medicine. It's easy and fairly obvious to point out that in human medicine, the technological and other areas of progress that we've seen just during the last 50 years are a vast multiple of all the progress in human medicine in the preceding 2,000 years. And you can be sure you can apply that to virtually every walk of life that you can think of. Let me give you just one more caveat for why forecasts often embarrassingly go wrong. This is one that you may know, so you have to give me some guidance, because this is an example that I have applied for my own amusement during talks to savvy investment professionals over the last several years, by starting such talks by showing a video that was originally produced by behavioral scientists at California Stanford University during the 1970s. This is a video which shows, and tell me if you know this because it's popular in academia, which shows 2 basketball teams playing against each other. Is that video familiar with everyone? Some yes, some no? Okay, very briefly. There are 2 basketball teams, one wears black t-shirts, the other one wears white t-shirts. I show this video and you can watch it on, for those of you who haven't seen it yet, you can see it online if you Google it. London Underground has recently integrated a very good version into one of their marketing ads. One team wears white t-shirts, the other team wears black t-shirts. I show this video, which lasts no more than 30 seconds, to an audience, and ask the audience to do me just one very simple favor, to count the number of times white players are passing the ball from one to another. But before I show the video, I emphasize how difficult it is to count the number of ball passes, because these players have been directed to run around so quickly that you as an audience will easily be confused. So you really have to stay tuned on the white players, follow them carefully, and count the number of passes. 30 seconds later, I'll ask the question, how many times has the ball been passed? Most people will give me the correct answer, which is 13. I'll ask the second question, anyone saw something different, something more unusual, which is usually then left out. And I'll ask, anyone saw something like a gorilla, by which time those who do not know the video will frown or think they're in the wrong room. And then I'll show the video again. And once you see that video again, there's absolutely no trick to the video. The only trick is to emphasize how difficult it is to count these ball passes. Everyone in the audience, of course, sees that for 15 out of 30 seconds, very, very slowly, a life-size gorilla walks across the basketball court, stands right in the middle of the camera, as I do now, just to beat his chest like this, and slowly walks off the other side of the court. Of course, the trick is not the video, but my dramatic overemphasis on how difficult it is to follow the players, which is utter nonsense. And anyways, who would have cared about such trivial questions in the first place? But this is precisely to illustrate how easy it can sometimes be to fool ourselves. While we are perfectly capable of counting the number of ball passes if we just focus on the white players, we miss something infinitely more interesting, namely a gorilla on the basketball track. And when you think of how we are fed news from the high-frequency media, the Financial Times, the Wall Street Journal, and my first piece of advice to any one of you who takes an interest in investing is stop reading the Wall Street Journal, stop reading the Financial Times, stop reading Bloomberg and these high-frequency providers. It's precisely to confuse us, not deliberately, but because somehow we seem almost surgically glued to these providers of high-frequency news who, for a professional reasons, claim that they know something new every single minute, which is nonsense. And if you really want to differentiate between the superior long-term investors and those who don't manage to outsmart the rest of the street, you will typically find that the superior investors are those who take that long-term perspective, who do take that step back. People like Warren Buffett, indeed, who don't follow every Fed and who don't necessarily manage their portfolio every day, but maybe just make one deal a year. Enough of these caveats. Let me take the time to talk about the world economy and financial markets. The world economy, I believe, is indeed in a better shape than the media are telling us. The media will always tell us that the world economy is in poor shape because bad news is good news in the media industry. Where should I start? I should probably start in Europe because that's where we are. So my 2 cents worth on Europe is the pricing of the political risk of a Eurozone crisis of an economic or a monetary sort was vastly undue 2 years ago and remains a mispricing in my book, largely because there's not the slightest chance, not the slightest necessity that the Eurozone would fall apart, as some would hope and some would fear, in the next decade. It may in 20 years, who knows, but that's too long for any investor to consider. And why? Because for one, there's no necessity, and secondly, a breakup of the Eurozone, even if it only meant expelling a small member like the Greeks or the Cypriots, would inevitably, and this is what the media like to position wrongly, create the worst political, economic and social catastrophe in Europe's post-war history. Because even if we expel just a tiny member, by necessity financial markets would assume that the next biggest, and then the next biggest, and then the next biggest member would be the next in line, and there's absolutely no mechanism to prevent that contagion. And Mario Draghi, who heads the only institution that still works properly in the Eurozone, has fully and totally understood that and shown his masterpiece in monetary policy in August 2011, was it, when he said, "And we'll do everything it takes to keep the Eurozone afloat. And believe me, that will be enough." That was a masterpiece in monetary policy. Why? Because there are 2 ways of conducting monetary policy. You can either use a big wallet, that's the Fed approach, the American approach, or you can use the power of credible promises. Obviously, the power of a credible promise is much cheaper than using your wallet. And when you compare the ECB's balance sheet with the Fed's balance sheet, it is quite obvious that this is the cheaper but equally effective monetary policy. That's why I call it a masterpiece in monetary policy. It's as simple as that. The rest is slim pickings for longer because I think we all agree, this is just pointing out the obvious, the Eurozone suffers from a generation of overspending. Angela Merkel likes to point out that it's home to 4% of the world's population, 25% of global GDP, and I think 50% of social security expenditures, and we can all figure out that that doesn't work out in the long term. So quite obviously, we now have to face a generation of tightening our belts. That's just pointing out the obvious. So it's slim pickings. But one more underestimated development that's working in Europe's favor and will surprise some at some point is the structural reforms which were forced by the Eurozone crisis and which have been made rather sustainable by the introduction of the Eurozone Compact Treaty will deliver structural benefits, just as Gerhard Schröder's labor market reforms were key to allowing Germany to leap forward. What has happened in Portugal, Spain, Ireland, even Italy, even Greece over the last several years will deliver fruits which nobody will be expecting, maybe even 214, but certainly 215. Let's move on. The United States is not only a currency where politics no longer work, but also one of ever surprising and impressive industrial vigor. And by all the talks and the statistics and the anecdotal and real evidence that I get from the US economy, what I can see is a clear industrialization of the US economy, which is patently obvious in the shrinking trade deficit, which is just an expression of the fact that companies, for political and economic reasons, are reshoring parts of their value chain from abroad back to the United States because energy is there in abundance and cheap, because the politicians want it, and because it actually makes economic sense because labor prices elsewhere in the world are moving up when they are going down in the United States. So forget the gridlock, Washington gridlock. That is not necessarily always bad. In fact, Washington gridlock, I believe, was installed by the founding fathers of the Federation for a good reason, because they were deeply skeptical of too much political interference. So gridlock will always be part of the US political agenda. But beyond that, The Economist recently rightly titled one of its issues, "There is an America that works," and that's the US real economy, where you can see housing price indicators moving up, where if you want to sell your house in the United States today, it takes roughly 50 days. 3 years ago, it would have taken you 150 days to sell your house. So there's real stuff going on. Purchasing power is going up, there are more jobs, more confidence, and all that feeds into a self-enforcing cycle. Let's move south of the border to Mexico. Things are looking up even more. Mexico has become much more productive than China. Mexico has been blessed with a fairly liberal, market-friendly government for quite some time, and is one of those places that is a key beneficiary. But it goes beyond that. You can see that most Latin economies, with a few odd exceptions of course, like Argentina being a basket case, but even Brazil, once it moves beyond their football games, will find that despite poor politics, despite governance errors, it is in a position where it's got everything it takes. It's got a symbiotic relationship with Asia, it's got free markets, and the genie of capitalism has moved out of the bottle, and it's difficult to get that back in there. Asia, of course, is a million-dollar question, not only for Latin, but for the sake of the world economy. And I've maintained the view that China's transformation is arguably the most important political, social, economic development that we are witnessing, and has very little to do with the myth that China is about to crash, the Chinese banking sector is a can of worms. Yes, it is, but China is strong enough to afford that. And let's not forget the German and the American banking sector a few years ago, and even today, isn't ideal either. I think what's really important to understand about China, and from there we can talk about the rest of Asia, is that if there's one thing we should learn from China's ascent to economic prevalence over the last 30 years, it's not to underestimate Chinese government's determination and ability to push through the realization of their 5-year plans. Time and again, these 5-year plans have been belittled and belittled, because the West has always been skeptical of planning and what have you. But for everything that might be wrong with planning, we've got to give them credit for 30 years of achievements. So we shouldn't underestimate, I believe, the last 5-year plan that was first drawn up in 2011 for 2011 to 2016, and firmly supported by last year's political reform package. Essentially, that 5-year plan can be described with just 1 or 2 sentences. The old business model in China was made in China. That was the old business model. Use all that excess cheap labor and turn it into the factory of the world. The new Chinese business model, that's how I would title the 2011 to 2016 5-year plan, can be called invented in China. Now, when you think of what it takes to go from made in China to invented in China, there's much more to it than just protecting intellectual property, which is a fact that you shouldn't oversee. Intellectual property court cases and won court cases have exploded virtually in the last 3 years in China. It's much more than that. It's investing in social security. It's investing in education. It's liberalizing the financial services sector, because without that you never get proper allocation of capital. Why do you need to invest into social security? Because you need to develop domestic consumers who buy Chinese local inventions. Well, the Chinese, as you know, are the proverbially biggest savers in the world. They save 50% of the savings and stash it under their mattress. Why? Because they don't trust the banks, and because there's no social security system. If you introduce a social security system whereby they can trust that when they grow old there will be a pension waiting for them, and they don't need to rely on the single child that they were allowed to create, then they will be prepared to spend those 50% of their lifetime savings, which is potentially one of the biggest catalysts for further growth in China that does not rely on just American consumers, as was the model in the past. That is why the new government is fostering precisely social security. And that will allow the Chinese parents to pay for more education, primary, secondary, and higher education. Have you witnessed that the biggest export good of Australia after the mining sector has become education? Australia is experiencing an enormous boom in educational services to Asia, because that's what's all in demand. Similar trends are happening across the rest of Asia, Malaysia, Indonesia, and the last IMF report rightly pointed out that virtually all of the heavy lifting of this year's economic growth, or the vast majority of it, will come from the 8 fastest growing economies, which is not only Brazil, Russia, India, and China, but of course also Turkey, Mexico, South Korea, and Indonesia. They collectively will contribute to more than 3/4 of global GDP growth this year, even by the conservative standards of the IMF. I'm not going to talk about the bright prospects for Africa and other more remote areas, but leave it here and point out that the growth prospect against which we stand is a sounder one than what I read in most of the financial media and what I see in investors' behavior. So how is that going to translate into financial asset classes? Let me start with the one that I am most concerned about, which is commodities. My concern is that despite of this, because of this sound global economic growth prospect, investors tend to underestimate the risk of severe bottlenecks in commodity markets. Bottlenecks which will take time and or capital to fix. When in financial markets you have a bottleneck which takes time and or capital to fix, you should be prepared for rapid price increases. And that's the long-term picture that I would see in this area for the next several years. I would argue that in commodities, they're really all the same. Food, power, water, by all practical purposes, they are identical. Let me tell you why. I go to Hong Kong very regularly, and every time I open the South China Morning Post in Hong Kong, they have some article on food shortages, on water shortages across China, and they talk about climate change, which I think has nothing to do with that, because I'm not denying climate change, but that's a much more long-term process. Water shortages and food shortages in China and India have everything to do with urbanization. If you dig for a well in China, these days you have to dig 500 meters deep. 15 years ago, you could have dug 50 meters deep to get water. It's the underground water aquifers which we're emptying in water-scarce areas like China. And once a water underground aquifer is empty, it takes 1,000 years to replenish it. So we don't have that time. China is fully well aware of that, which is why the Chinese government has ordered the construction of roughly 450 massive desalination plants over the last 3 years. These desalination plants will be equal in size to what is currently the world's biggest, which operates in Tel Aviv, Israel, and the latest technology, which is based on reverse osmosis, not that old-fashioned technology they use in the Gulf states. I once tried to do a very, very simplistic back-on-the-envelope calculation to figure out how these 450 plants will operate when they go live this year and next year. And you find out very quickly that the biggest operational cost in this is not labor, of course, it's power. Because the way these work is they take salt water, they push it through a very strong membrane, which is strong enough not to burst, but porous enough in order to allow the water to pass through it, which takes power. And very conservatively calculated, the additional monthly power bill for 450 of these plants, just the incremental power bill, would be roughly $50 billion. So that's $600 billion in additional electricity bills to power their water plants. Now, when you then figure out that 70% of global water demand goes into agriculture, it becomes patently obvious why water in the 21st century, that's different from the past, at least not here in Germany, but at least in the most popular demographically and ecologically constrained areas of the world, water equals power, and without water and power there's no food. Which is why I'm concerned that the secular bull market in commodity prices is likely to stay. Now, this is a part of where one could get terribly gloomy. I'm not as that gloomy because I believe that there are ample efficiency gains that we will and can reap, but it takes time for them across the entire value chain. Upstream, where we explore the stuff, midstream, where we distribute water, power, and food to consumers, and downstream, where we actually could consume much more efficiently. That, by the way, is why the English, it does rain in England, as you know. The English face water shortages every summer, even though they have ample underground water and rain coming from the clouds. The reason why they have water shortages every summer is because they're using a Victorian infrastructure in the 21st century. Because 80% of the water they pump into Thames water pipes leaks before it comes out of your bathroom. And there are similar examples I could tell you about the value chain in the food and in the power business, which gives me enough reason to be confident about the long term but concerned about the short term. Let me move on in the interest of time on FX, interest rates, and equities. I'm not an FX speculator, and I don't have any short-term views on currencies, but I have long-term views. First, that economics trumps politics. That's an important view because currently there is a political agenda by virtually every large central bank to debase its own currency, which I think you can do in the short term, but I believe in the long term economics trumps politics. And secondly, I have the view that strong currencies do appreciate. Now, what is a strong and what is a weak currency? I think there are, very simplistically again, put 4 criteria by which you can judge one from the other. I think a strong currency is one that is issued by a country with consistent current account surpluses, number 1, which secondly shows improving productivity criteria. I mention that as a second criterion because I want to exclude countries that only export their natural wealth, like Saudi Arabia does. So a country which does something time and again becomes better, therefore productivity improves, right? If that country, thirdly, attracts rising foreign direct investments, which obviously leads to buying up of the currency, and fourthly, now this is a lot to ask for, if that currency pays a relatively high level of real interest rates. Forget about nominal rates, I'm only talking about real interest rates. If you can spot a country which ticks those 4 boxes, my belief is the currency will go up in the long term, and the opposite is equally true. So, what are the currencies that would fit that bill? Last year I conducted a very simplistic study on those 4 criteria, and it turned out the number 4, the 4 best ranked currencies were, I think that study was done in December, early December, were Malay ringgit, Thai baht, Mexican lira, and South Korean won. And the bottom three, I remember, were the Hungarian forint, pound sterling, and New Zealand dollar, for whatever reason. But it makes a lot of sense to me when I think about the currencies at both the bottom and the top end of the league. They strongly fulfill these criteria. Interest rates, my view has been lower for longer for the last more than 10 years. I've said this time and again, very simply, there are two reasons why interest rates will just stay flat as it is. They'll stay flat for two reasons. The first reason is demographics, again, so often underestimated. It's very simple. The biggest investors in the world are Western investors from Europe and the United States and Japan. These are precisely the countries where demographic aging is happening rapidly. I'm still a member of a pension fund, of the advisory board of a pension fund, which last year, when we closed our books, had 18 new joiners. That were 18 people who retired, who from now on are taking their annual pension from that fund. And only 4 people passed away. Now, don't get me wrong, I wasn't hoping that more people would die quickly, but the insurance mathematicians who drew up the long-term asset and liability scenario for that fund always told us differently. Think about linear thinking. They always told us in the medium term the people who pass away and the new joiners were balanced. They no longer do. They will no longer do because we live longer and because we no longer procreate. The baby boomers are dying out and life expectancy is moving up. What happens? Pension funds, the world's biggest investors, are forced to become more risk averse. There's no doubt about this. What happens if you're forced to become more risk averse? There's only one conclusion. You're a structural forced buyer of government bonds. So for the last 30 years, since the early 1980s, remember US dollar bond yields at 18% in the early 1980s? Now they're flat out of the bottom. Aging, longevity, and the disappearance of those baby boomers have forced pension funds to buy long government bonds and will continue to do so until I can see a change in the demographic pictures. Now, adding insult to injury, quantitative easing and the monetary policy reaction to the 2007 crisis is just reinforcing this, because if there's one forecasting certainty I think we have, it is that still policymakers around the world are hyper-nervous. Hyper-nervous policymakers are eager to pull the trigger on quantitative easing. So more of that to happen. Which lastly brings me to equity markets. Stock investors usually like to do valuation analysis, price earnings, price book value analysis. Well, actually, you should do the same when you buy bonds. If you buy a 10 or 30-year bond, or a US Treasury bond yielding 2%, well, that's a high yield. The inversion of 2% gives you the implied price-earnings ratio of the bond. So dividing 2 by 100 gives you 50 times. If you buy a bond yielding 2%, the implied price-earnings ratio is 50. It will take you 50 years until you make your money back. John Maynard Keynes used to say, in the long run, we're all dead. You're all very young, but 50 years, I believe, even by your standards, is a long investment horizon. And if you're audacious enough to buy a Swiss government bond, which yields 1%, even less than that, you'll have to wait for more than 100 years to make your money back. That's pretty audacious to do that. When you look at the global price-earnings ratio, it's give and take 15. The Swiss market is trading at 10 times earnings. 10 times earnings when Swiss government bonds are trading at 100 times earnings. All I'm observing is that the gap between stocks and bonds has rarely been wider than it is today. Despite the fact that, yes, we are in year 5 of a 5-year equity bull market, which started in 2008, and I believe will continue until 2018. This is at least a decade, a 10-year equity bull market, which will have the occasional negative year too. But if you take that long view, I think the important observation to make is just this. Over the next 5 years, when investors realize that long bond yields will remain stubbornly low, it will become perceivable that equities no longer trade at 15 times earnings, but at 30 times earnings. There's absolutely nothing wrong paying 30 times earnings after a period of 10 years of zero-bound interest rates and bond yields. That, I think, is the important picture there. And another just anecdotal support for this, I'm not going to bombard you with more statistical reasoning, is the old truism on Wall Street that every bull market on Wall Street, without any exception, be it in gold, commodities, stocks or bonds, every bull market always had to climb a high wall of worry. It's only when everyone tells you this is a fantastic bull market, like in 2000 when the tech bubble was just at its peak and every housewife had their show on television arguing why and which stocks they would buy for the long term. When everyone talks of it, you can be assured this must be the end of it. But the reason I'm still confident, being halfway through this equity bull market, that we're only halfway through, is that if I look at investors' portfolios, they speak louder than words. Investors may have become more optimistic in their speaking, but investors' portfolios, when I look at them, are still more overweight in cash and fixed income securities than at any point in time in the last 10 years and beyond it. Let me conclude. When I talk to investors about what I consider the emergence of a new world order, I'm often asked, especially when I'm in Hong Kong or in Asia or in Latin America, well, is this the inevitable rise of the East and the decline of the West? And all of you who sometimes fly around the world, when you go into bookshops in airports, it's very easy to pick up at least a dozen books by economists, philosophers, political scientists, and what have you, to make precisely that argument, the decline of the West and the rise of the East. I don't really like to buy into that argument, because I don't think that history would support the view that it's regions which have been shaping the shape of the world. I would much more agree with the quote that's attributed to the French philosopher Victor Hugo, who once is supposed to have said, "The power of an idea whose time has come is stronger than all of the world's armies." And I think there's a lot of truth in that. I think the power of ideas is more relevant in understanding history than regional powers. One of the ideas that I believe is more important, more powerful today in the 21st century, in 2014, which can make or break the answer to whether this might be China's decade, or whether this might be India's decade, or the BRICS decade. The answer to that will be, I believe, in the idea of sustainable development. And when I say sustainable development, I mean that at all three relevant levels: a political level, a business level, by describing the way managers and owners are running their businesses, and thirdly, an individual level, which is the way every one of us, by using our resources, immaterial or material resources, we are taking a decision and we are contributing to a more sustainable development of a business, a country, or a region. That, I believe, is the responsibility which we have as investors. And it also shows the opportunities that we have, whether we live in good old Europe or in tomorrow's Europe, doesn't matter. Thank you. I think there's a few more minutes left, so I'd be happy to take any questions. Yes.
You said that all commodities are pretty much equal. Would you also include gold in that? Or would you say gold is somewhat special?
I think gold is somewhat special because it doesn't really have a, there's no necessity for gold. It's really a currency. It's a currency, that's what it is. And when every other currency has lost its carry, it's just as good as dollars and euros and Swissies. Yes, sir.
Do you have any views on cryptocurrencies?
Bitcoin?
No, I don't. The question was if I have any views on those modern currencies. No, I guess I'm too old for that now. Yes, sir.
Yeah, you said economics trumps politics.
Yes.
And two questions for that. So first, how do you combine that with increased regulations that are implemented by politicians, in your view? And then secondly, one could argue that sovereign wealth funds are mainly politically motivated and try to serve their country or nationality. So the increased power that those sovereign wealth funds are gaining, how does that fit into the same?
Right. Well, so let me start with the first question. I think, more regulation is just like a tax on business. Unfortunately, mostly. If it was enlightened regulation, it would be less tax, but most of it is not particularly enlightened. So it just means, additional burdens to doing business. But it changes nothing to the fundamental belief that economic trumps politics. If policymakers decide to impose, for the banking industry, more than 100,000 new pieces of regulation, that's what we've seen in Europe over the last 5 years, that's a political decision which weakens the economic power of the financial sector, which is a perfectly legitimate political decision to take, and vice versa, strengthens the relative economic strength of the American and Asian financial sector. Your second question on sovereign wealth funds, of course they have political objectives, but having spoken to certainly the 5 largest sovereign wealth funds in the world fairly regularly, I think the overarching objective for all these people who manage these funds, and frankly the 5 largest sovereign wealth funds, they represent roughly 90% of the global sovereign wealth fund area. These are investment professionals. They have some political guidelines on where they can invest and where they should invest for political reasons, but within that, all of these managers are shrewd investment professionals. They are the best and the brightest from their sector. And what's interesting is that all of them have a very, very clear agenda that they take the aspect of sustainable investment much more into the center of their investment framework than they certainly did 5 years ago. Yes?
And how would you describe sustainable investment? So do you refer to rather long-term investment decisions or to sustainability in the sense of environment, for example, or energy?
It's a holistic way of investing. It's something that is still that is much more being used today as a topic than 5 years ago, and I think 5 years from now nobody will talk about it anymore. Just like people talked about e-commerce in 2000, and nowadays everybody practices, but we don't specify it, we don't spell it out. It's a result of the insight that a lot of investment managers in the past were biased, probably, that's my subjective take on it, biased by the academic look at valuing a company, doing your discounted cash flow model, etc. Whereas all the other subjects that you did in your CFA course were easily and quickly forgotten and never mattered really for investment selection. There's nothing earth-shattering about this. This is really just old-fashioned, common sense, broad perspective, holistic investment. Making sure the company you invest in isn't turning a blind eye. It's not producing something and turns a blind eye on the waste ground it produces just around the corner. It's not turning a blind eye on the way it treats employee, because it knows in the 21st century this stuff backfires very badly. And that, I believe, is one of the blessings of globalization and a much more transparent world, that corporates have are forced to become much better citizens. And by virtue of mutual benefit, investors and corporates increasingly take an interest in broadening that horizon. It's good for investors, it's good for corporates, and I think it's something that's here to stay for the next few years. Yes, sir.
You kind of skipped over Africa a bit. I know it's quite broad, but maybe you can give a quick snapshot of your opinion on South Africa and Nigeria.
Sure. Well, look, I travel to Africa every second month, and I've been doing that for the last 10 years. So yes, I do have a very strong view. I think Africa is the silent winner of globalization. Europeans have largely misunderstood it. Europeans have largely put a blind eye on it because they shot themselves into the knee when they did the colonization more than 100 years ago. Not more than 100 to 50 years ago. Americans have also put a blind eye on it, and a lot of investors from India, the Middle East, and also China are spotting it. But it's quite obvious. Africa has had growth rates between 5 to 10% for the last 5 to 10 years. Africa has had less political turmoil, less civil strifes, less military conflicts than in the past years. Why? Because people have more to lose, because prosperity brings wealth, brings an interest in protecting it, brings an interest in protecting all that peace. And the way I see it, it's the last big reservoir of untapped human resources. You know, China is done. Indonesia and Malaysia is no longer cheap. So it's a matter of a few years when you will see companies having shifted all their cheap sweatshops from China to Southeast Asia, and then they'll move to Africa. And at the same time, Africa is not just dependent on that, but it will help because Africa still has vast underemployment. That's quite abundant. But it's leapfrogging technology in many ways. Can you make money from that? It's much more difficult to make money from that. Don't invest into these investment funds, investment companies which are being marketed as Africa investments. They usually don't work. Usually they're companies listed on the alternative stock market in London. They do a lot of business in Africa, but stock price performance is much more to do with local listing than with where the business actually takes place. If you want to make money in Africa, the best way I think to do so is to go there, buy land. An old entrepreneur who started investing in Africa in the early 1930s once confided to me that in the 1930s his way of doing business was if he traveled to a country he liked, he would inquire who's the best lawyer in this country. He went to see him. He would say, I like your country, I want to invest here. Let's circle 5 miles around the biggest airport. Let's set up a special purpose vehicle, which I will own majority, and you as the best lawyer in this country will become the chairman, often own a small stake in it. And let's together buy land as much as we can, 5 miles around the airport. That might sound old-fashioned, but it's a very, very good, tried and tested way of investing. Okay, I think it's time to go. Thank you so much for having me here. Have a good afternoon.